I've got to be a bit careful probably what I say, because every personal investor and resi agent will probably follow this advice, but we'll put it on the line. It's not an asset class I'd rush to buy in, but if you're an owner-occupier or you're a long-term investor and there's something just unique about the property, you'd probably consider it's a good time to buy in 2025.
Should you expect interest rate cuts in 2025? Yes, but when?
I've got two big predictions on that topic. It's definitely a good year to hold property, so I'm not rushing to sell anything, because you'd be mad too if interest rates drop. You're going to get a sugar hit into this market, so you may as well sell after. If you've got a bit of both, you can afford to negatively gear, or you've got a really good paying job like you, go negatively gear.
God. G'day, how you going? Phil Tarrant, co-host of Inside Commercial Property. Welcome to 2025 and our 56th episode of this podcast. And I think it's changed a lot of habits and behaviors when it comes to commercial investing over the last 5 years. So we look forward to marking our 5th year anniversary of this podcast series in a couple of months' time. But here we are, the 2nd of January. I've been pulled out of my summer holidays to come and spend time with Scott Arnell, who I've seen enough of during the year. So I don't know why I'm giving up my time to come and chat with him about commercial property. But Scott, everyone's sitting on beaches right now thinking about where they're going to invest in 2025. So
it's true.
We should get together and launch out 2025 of the podcast. How you going?
Yeah, good. Including yourself. I heard you're thinking of looking to invest this year.
I am.
Many others?
I am. Yeah, I've got to find a good buyer's agent. I don't know where I'll find them, but if you know someone, let me know. But I don't think I'm doing enough. I always prioritize other things than my own commercial property portfolio or resi property portfolio. So
too busy playing the media mogul, I think.
I was trying
got to slow down.
You're the media mogul. I've seen some of the stories of you in the papers over the last few months, and you're certainly doing well. But how's the break going for you, mate? You take the time off?
Yeah. Needed the break. It's been 2024 was madness, as many in this industry know, but in a good way. Like it's really been a surprising year. Like we thought there were going to be some rate cuts, and there were none. And now they're talking about some coming this year, and it's I think there's a bit of a swell rising at the moment. So hence why we're back early, just to get stuck into this year and go back some of our predictions that we had early in late 2023 for 2024. So we'll review how we went, and also give our thoughts where it's all going.
All right, so we're going to get the scoreboard out to see who made the best predictions. I don't give predictions. I'm just a journo mumbling through different ideas and thoughts that I have. So don't consider anything I say is fact. Most of it is fiction, but my job's really to navigate conversations with Scott and some of our guests that come in. We had some great guests in 2024, and contextually, I guess it's irrelevant. I saw some of it popping up on my social media over the break. The last podcast for 2024 was with Steve McKnight, and you chose one of the clips or one of the threads or reels on social media was, hey, the first property book you read was on a beach somewhere in Italy, and that was really sort of the catalyst for igniting a burn inside of you to build out a property portfolio. No doubt people are sitting on a beach somewhere, or most people I think are skiing in Japan at the moment, but tuning into this podcast, the new property investment books, and this might start people's property investment journey for 2025.
Oh, it's when you get clarity. You're out of your day job. You've got a bit of time to think. It's where probably most of us have come up with our business ideas, when you're in the downtime. So yeah, no, it's a great time to plan. Most people set goals this time of year as well. So if you're not setting goals, highly recommend it. Just put them, in a spreadsheet or on a bit of paper, what you want to achieve for 2025, whether it's, business related, whether it's property or income or whatever, health, put it in, and it's a great thing to come back in 12 months time to review as well.
Yeah. And we normally get pretty good briefs on this show, but this really thorough briefing, and I think we're going to need it to help us steer a conversation around looking back on the year past and what we expect in 2024. You got a great team at Rethink. One of the milestones of last year was the rebrand of the Rethink group. That was a pretty big deal for you guys.
Yeah. Like it's
not a rebrand, it's an evolution of the brand, maybe.
We're kind of going not a corporate direction, but more of a big business direction. We've got larger and larger influences with all the different businesses we've got. And the idea of the group is to get all the businesses growing at the same speed rather than going all different directions. And when you do that, there's a bit of harmony between the businesses. The customer experience is a lot better, especially when you're dabbling with a high risk or, highly complicated type of asset class like commercial. You can't be using all the random people you brought from residential. So, and the businesses need to kind of understand this. They're all independent still. They have to be, but their customer experience is getting better and better. And we need to, because we deal with large volumes and we're quite influential in the market. So we're just getting perfect. That's the idea, and always trying to improve. And having a big, strong corporate brand is a way of doing that.
So we're sort of reflecting on the year past, and we've been working on this together for 5 years or so. Are you into podcasting as much today as what you were sort of 5 years ago when we kicked this off?
Oh, look, no, the one I like doing this one with you. This is like a lot of the other ones are really just talk about the life story, which it's always good to do that every now and then, but we don't go deep into the asset class. And this is why this podcast has been so popular over the years, because everyone can touch on commercial. What's industrial versus retail versus what's a cap rate. Boring. We've all heard that. There's multiple books for that. There's multiple education courses, but I guess keeping up with the market is how I've always invested. So this podcast is for me. It makes me learn about the market, keep up to date with the stats. And by doing that, it helps me kind of direct where we invest for our clients. And nowadays it's way more about the clients and my own portfolio. Like I'm definitely on the back seat in terms of investing more.
I don't think you need a larger portfolio.
No, it's consolidating now. So I'll probably be selling down assets to pay debt off for some of the larger commercial investments. So I might sell down a few resis this year. It all depends on what happens with the market month to month, but it's definitely a good year to hold property. So I'm not rushing to sell anything, because you'd be mad too if interest rates drop. You're going to get a sugar hit into this market, so you may as well sell after that. So that's a thought. There's going to be more stock when interest rates drop because of that exact mindset. I'll get more money after the rates drop. It's happened in New Zealand already. They've had multiple rate cuts and prices are going up there quickly. So, that's the lesson to everyone. If they're waiting to buy, try buy before the rate cuts, and after it, you're going to have more selection anyway. So it could be good or bad, depending on how you look at it.
But 2024, we made some predictions sort of this time, or was December of 2023. And I think what it sort of highlighted to me is that nothing is a given in property investing. I think largely our sentiments and our thought process has been right. And I think we probably done pretty well through the whole 5-year period since COVID outbreak. When the world was going mad, we give a sense of stability and continuity and help people steer and navigate themselves through commercial or wider property investing. I've got some ideas I want to share with you around commercial property for 2025 when we talk about what we expect this year. But 2024 performance overall for commercial properties, what you thought?
Yeah, well, look, it was a very good year. We saw, I'll read some capital growth figures out for industrial. So this is on the this figure will really surprise you. I'll test you. What do you think industrial prime grew last year or declined?
Nationwide,
just straight out of the Knight Frank style reports or JLL.
Oh, you're going to highlight to everyone I don't know anything about property. 11.5%.
Negative 3%.
There you go.
Yeah.
So it went backwards.
You know why? Because the yields were too tight.
Yeah.
Interest rates weren't cutting it. And basically there was a flight towards yield. So because industrial was the tightest cap rate, especially prime assets, these are your 5,000 plus square meter sheds, there was there's no yield. Well, there's a yield decompression effectively.
So compression and yield.
Decompression.
Yeah.
So basically people needed better yield and that influenced the square meter rate. So surprising figure, because you think, industrial is red hot.
So most people have gone backwards if they held those assets.
If you bought a really tight yielding industrial, sure. Secondary is a different story. That's the stuff that's why we're strict on our yield. If you maintain 6%, you did very well. But if you bought a 4% industrial, now that's probably trading at 4.5 to 5, you've lost money, even with the rent growth. So it just illustrates, even in a good industrial market, you still got to get the cash flow, the cash flow right. Retail, I won't keep testing you. That went up 5%. So the reason that went better is it had a better starting yield. So, and this is, we'll go into predictions next year, but we will basically see a very good retail market next year because it's starting from a higher yield base. There's 1 million extra people in the country. We've gone from 26.5 to 27.5 million people. So that extra 3.8% people are all scattered around all the suburbs over Australia buying stuff. That's a new base load, and most of them are fairly rich migrants too, which is perfect for retail. And it's coming off a lower base, so there's more upside in retail.
So 2025,
Yep.
This year, retail is something to be considering. So these the shine off. Well, we get into it. The shine is off industrial, prime industrial.
Prime, yes, because the yield's too low. So there's a flight to yield.
Yeah.
So that's a general comment for all asset classes. You're going to see good yielding assets perform well. And I know you're not going to go buy a really low yielding investment, mostly because investors are thinking long term the interest rates aren't going back to 3%.
Yeah.
They might go back to 5%. Who knows? Guessing that is a mug's game. But if you have a base load of, say, a 5.5% interest rate and you're buying premium assets at 4.5%, it doesn't add up. So there's going to be an adjustment in the lower yielding space. But if you're lucky enough to get a 6.5% yield, and that goes to 5%, you could imagine the upside in that versus the downside in the others. So yield is going to be very important for investors, especially with the baby boomer glut hitting the market, and they need cash flow. And a lot of resi investors are sick of negatively gearing year after year. So there's going to be more money flow towards cash flow assets. So that's why retail will be good, because overall it's averaging a high yield. Industrial, prime is too tight, but the secondary stuff, older sheds, lower site coverage stuff, there's potentially a very good year ahead for that.
But often the people buying prime industrial aren't your sort of mum and dad sort of investors. They're not even. I think we sort of framed it with Steve McKnight, who we caught up with in December. Did a podcast with him. Was sort of that. It's not even really that middle market, right? It's your big family offices or instos, and they're happy to take a bit of a haircut for a period of time where they see long term growth in these large prime industrial, which are popping up everywhere, by the way. You can't drive anywhere now without sort of seeing a whole new, new greenfield development of this sort of stuff. It's popping up everywhere. So there's probably more choice in the market at the moment. There's more stock coming on. But anyway, that's getting more about predictions of this year. So office in 2024?
Negative 10%.
Yeah.
So obviously pretty bad, but it's looking like it's bottoming out. And we're starting to work for quite a few owner occupiers in mostly Sydney CBD looking for offices, and they're now seeing it as good value. So they're more prime office type characters. So it's a two-speed market. You've got your secondary stuff, like your old, 40-year-old type stuff. That's almost a dead product. So that's going to be it's going to run its own race the wrong way. But then you've got premium office, like you're in North Sydney. That's such a good example. The premium stuff leases out, and then the other stuff just...
A lot of old stuff there, right? And it's all getting redeveloped.
It's going to have to.
As we speak. A lot of it's turning into apartments, right? You're seeing this sort of quasi-infill gentrification type thing where traditional commercial hubs are turning into hybrids.
Yeah.
And you'll see that up and down, there's rezoning right throughout the whole northern parts of Sydney, for example. You see the equivalents elsewhere, and that's going to be mixtures of high-rise resi with commercial.
Yeah, exactly.
That's that way we're going to live moving forward.
Yeah. So you might see office take a turn, starting with the prime. Might be mid this year. No one's going to call the bottom perfectly, but that market's starting to look fairly good value. Vacancy rates are tightening in some areas. So it's not an asset class I'd rush to buy in, but if you're an owner occupier or you're a long-term investor and there's something just unique about the property, you'd probably consider it's a good time to buy in 2025.
We said a year and a bit ago that 2024 would be a strategic year for buying ahead of rate cuts. That we said 2025. There was a couple of predictions there. I thought we caught up with an economist who was calling rate cuts from as early as May 2024, and that was the consensus at that point in time. Yep. I think pretty much every bank was assuming there was going to be rate cuts by May 2024, which didn't eventuate. And then there was a whole bunch of scuttlebutt about whether or not rates had come down later on in the year, which they didn't. The RBA handed down its last rate cut notice in December, which sort of stayed neutral. And subsequent to that, the day after that, I actually caught up with the Shadow Treasurer, and we're chatting about this specifically. And we know from 2025, there's going to be this new sort of dual board type scenario where you've got a monetary policy board and a sort of RBA board. We don't yet know when the election, is really going to fall. So interest rate cuts, I think, is going to be a theme moving forward. Do you reckon you got it wrong, sort of saying rate cuts after May?
Yeah, from memory, it was the podcast with Nerida, and at the time, I think Nerida was predicting 3 rate cuts by the end of 2024, and this is like all the stats pointed to that. Like the I guess the rhetoric coming from the RBA was very different to. It's kind of swung back the other way recently. I thought 3 was a little bit bullish. I went with 2 at the time, and surprised it didn't happen. But like then the months following those podcasts, it really changed. It was all talk about like rising rates because of this, the inflation figures was really slow, and there's almost a bit of stubbornness, like similar to what Philip Lowe did at the time, where he just wanted to hold too long. It was almost like, are we in a similar mindset? They just want to create stability rather than change the game, because I think they were always scared about the property market going wild. If they dropped, and that's what I did say at the time, I remember saying, if they drop the rates, like the investors are going to go wild.
Yeah.
They're going to just pay more and more, and that's going to fuel it potentially. So maybe that was in the back of the head because unemployment was low. Like the economy was, I know we're in a per capita recession, but it was pretty solid, So if the wrong thing happened, then it could have went really bad. So maybe that's why they took that really hawkish view all year.
Yeah, and the next time the RBA makes its interest rate decision will be a key moment. It's going to fall into this gap of a handful of months in between when the election is going to be held and when that announcement will take place, and no doubt the government's sort of hoping that the next call is a downwards call. I don't think it'll happen. I'll put it out there. I reckon, should you expect interest rate cuts in 2025? Yes, but when? It's a big what if. Depending what happens with the configuration of the new sort of board for that makes the determination of interest rate setting. There's some of the talk is around stacking it in a sort of favourable way so the government can force the hand of the RBA. But big trend for 2024 was the independence of the Reserve Bank of Australia and the governor sort of holding the line. There was a whole period of time where, essentially the government and the RBA were at war with each other. You think back to, when was the sort of August, September, October, when they were at each other pretty much going, we're not going to be dictated by the government when we make our calls on interest rates. And by the way, don't just assume they're going to go down. They still may be going up, right? That was at that back in time. So I don't know if anyone really got the interest rate discussion right in 2024.
No, and it's possible to do it. Like every day the stats change. Like I watch the ASX RBA tracker, which is basically the market pricing, and it changes every day almost. So yeah, it's more about the trend, which is more important. Like the trend was rates were probably not going to come as quick or hard as we all thought. And it's been good that it didn't as buyers. Like even the people that are like the type of investments we're in, which is mostly high yielding, like we're as protected as anyone from higher interest rates. But if you went and negatively geared 5 houses, you'd be really hurting by now.
Yeah.
So
I think there's a lot of people hurting right now. Absolutely.
There has to be.
You hear it anecdotally. There's still people selling down, and property markets at the back end of 2024 were pretty lackluster. Some of the last auction rates I saw was, Sydney falling into like 50% clearance rates and these sort of numbers, right? Everyone holding firm, vendor expectation around prices, and they're going, I'll sell it this year.
Yeah.
There's a glut of stock on market coming like downstream right now. So it's a real topsy-turvy market.
For sure. And to prove your point, like looking at some of the stats, like the higher price, lower yielding markets suffer the most. Like in the last 12 months, this is data to basically the start of December. Sydney went up 3.3%, Melbourne back 2.3%, Canberra and Hobart -1. Canberra was -0.1, sorry. Canberra was -1. And then the high yielding ones like Perth, 21% up, Adelaide, 14% up, Brisbane, 12.5%. Like obviously there's cheaper prices there too, which means probably, their loans aren't as big. So yeah, I guess interest rates punish different markets more than others. So yeah, really mixed bag last year. And I think you're going to get the same in 2025.
Yeah, I absolutely agree. I think there'll be different locations, but you'll see some commonality. But thinking back to 2024, I think your business made a core decision to say, I think in many ways, one of your greatest successes was one of the greatest issues you had was that everyone just thought you were a commercial buyer's agent. And this podcast, I think, because it was so popular and has really sort of changed a lot of narratives and mindsets around commercial property. People forgot that you guys actually still do resi stuff, and you're like, yeah, you saw value in the right resi markets. What was the total growth over the year for resi property? I think you reckoned about 10% by memory.
Yeah, so I predicted 10%. It ended up being just under 6%. So I guess the reason it was low was no one really predicted how bad Melbourne was going to go.
Yeah,
I think that was the outlier. Some of the smaller markets went off their head. No one predicted Perth would go that well as well, like 20% plus growth rates. That's the buyer's agent effect, in my opinion. You talk to lots of buyer's agents. They've got significant influence over the market as well. These resi buyer's agents might be buying 50 properties per month. If you've got 10 of them, 500 a month, that can influence entire capital cities sometimes. So let alone if they all go to Rockhampton, or what they're doing now is they're all going to Townsville, you could flood the market, and that creates a potential pump and dump scheme. So I worry about, the packs running out now. It's a very different market than you and I have ever seen in our lives. So, one would argue we probably could have done that to commercial, like the low stock. If we all decide, we're all going to go after Adelaide industrial, 100% we could push the market up.
Yeah, and we need to be conscious of that. And whether or not everyone's trying to emulate the success of your business, or everyone has now widen or I've got a more expansive mindset because of tuning into podcasts like this. People are shifting to commercial, which is going to be tough for you because buyer's agents are now moving into this space in droves. Not all buyer's agents are created equal.
No. Well, look, I got two big predictions on that topic. So number one, the market needs commercial now because there's, I guess, more experienced resi investors than ever that are hurting, just like you said. So they need to fix their portfolios. So that's going to mean they'll either refinance what they can. As soon as the interest rates drop, that means they've got more lending power too. So there's going to be equity there. And then they're not going to go buy another 5 houses. They're going to go into commercial. So it makes sense from a mathematical point of view, from a diversity point of view, from a, just a pure retirement point of view. You need to consider this asset class. But the other big prediction is most of these resi buyers agents are at capacity. They've got long waiting lists, and they're all going to try to get into commercial because it's income generating for them. But the problem is most of them are going to be in that entry-level price point. And this is the big problem. They're all going to go out and try buy vacant industrial sheds or buy little sketchy retail assets in regional areas. They're going to be playing in the risky game, and they don't have the experience of 10 years of knowing what happens with leases, what happens when you go into a down market. There's going to be potential bloodbaths there if they all get in and do what they're doing in the resi field. And luckily, we don't compete much in that space. So I don't think it'll affect us unless they all have $3-4 million clients floating around. And if they do, there's actually more stock.
There's not that many of them around.
Exactly.
To be honest with you.
So it's going to be a bit of a basket case of that lower end of the market. And that's why I think resi is becoming more important for us, because I don't want to recommend everyone to go into that entry-level price point and then compete against 20 different buyers agents trying to flog you into, cheaper assets, because it is riskier. The smaller tenants, they are by nature less experienced, or they're mum and dad type operators who might be retiring, or they've got, a business that's been running for 20 years and they're passing it on to someone else, or they're, selling businesses different, there's all sorts of things that change. So got to be very careful. So that's the big prediction. Be wary of more people talking about it. That'll be good for us, by the way. If more people talk about it, they do flow up the path and they'll go to the more experienced buyers agents like nature. So I think I'm excited for the year, but there's obviously going to be a period or a point in the market which is almost going to be a bit of a disaster, I think, through too much competition.
Yeah, and I caution the buyers agency sector around it. Look, and I think it's a very important component of the real estate sector. Buyers agents, for the right people, they do a great job. You don't have to use a buyers agent; you do it yourself. That's cool. However, structurally, commercial property is not as forgiving as a bad residential or a less than ideal residential asset selection for a client. It can go a lot more wrong in commercial, but structurally, and you point to this all the time, that the size of the commercial market compared to the resi market in Australia, it's tiny, it's minuscule, and there is not that many, inverted commas, good deals out there. You guys hunt them, you interrogate them, you say no to more than what you say yes.
Yeah. And look, statistically, there's only about 2,500 to 3,000 properties Australia-wide with a tenant under 10 million available per year.
There you go.
That's it.
So what's that number again?
About 3,000. Yeah, if you look at, because we've done data grabs on real commercial and
It's
commercial
hard to
real
find
estate.
this info, right? We've spoken about this before.
Yeah, it's very rare because there's about kind of 20 odd thousand transactions per year, but a lot of it's in the institutional level and a lot of it's blocks of dirt that have commercial dirt zoning. Like a lot of it's not a really, an investment that we'd be looking at. So it's extremely small stuff. So the deal flow is not there. Resi, you're talking 600,000 type deals per year. So
600,000 resi deals a year, 20,000 commercial deals a year, and you're saying
in that 20,000, you're only really looking at about
3,000 deals sub 10 million
sub
bucks.
10 mil. And how many of those under 1 mil? I haven't done that stat. We'll probably dig that up, but
the market's tiny. I probably know 3,000 property investors who have commercial property,
and that's why there's only a handful of commercial buyers agents.
Yeah,
it's just there's no market for it. So we've got a very high market share, and it's ours to lose in a way because it's a high percentage. I don't think we'll keep that forever. Whatever, we've had a good run type of thing. It's not the end of the world, but look, resi is sort of where the bulk of people will still need to go because you can't start taking shortcuts on commercial just because you want to get into commercial. You really need to up your budget. That's the answer.
I think you'll have earlier mover commercial property investors who have been in the game for quite some time, who have calibrated their portfolio from a cash flow point of view and are probably looking pretty good. They're going to have capacity to hold negatively geared, higher value resi property because of a surplus inside of their commercial portfolio. And I think a lot of the smart ones will be out there looking for sort of mid to higher market level resi purchases that are going to accelerate capital growth. And I'm thinking towards maybe in Melbourne or so, I think it's undervalued, right?
Makes sense.
That's going to be the inverse trend emerging. And no doubt you've probably already seen that where you got, cash flow positive commercial investors going, hang on a second,
Yeah, well, look, if you've got a bit of both, you can afford to negatively gear, or you've got a really good paying job like you, go negatively gear.
God.
But you can, I think it's all about deploying money safely in a market. And you can I think commercial is safer than resi when you get the right asset. It's just not every asset's going to be that safe. So you got to really pick well, and you will beat the best of residential any day of the week. Like I know in my own personal portfolio, deals like, my KFC deal, bought that for 9.8. It was worth over 13 mil pretty quickly. That's pretty good equity with not one missed payment. My resi portfolio, if you combine them all to create the same dollar amount, didn't do those types of numbers, plus a lot more headaches. So there's different types of investments out there. But look, prime resi is still going to go well long term. The stats prove that. But the cash flow is the big issue. So there is going to be a flight towards higher cash flow because a lot of people have gone a little bit too heavy with the let's keep buying lots of property strategy. It's like an ego thing. How many properties you got? The more you buy, the bigger you feel. But it's not the amount of properties; it's the amount of income you got, and also you got to hold that for 20 years. And I just don't. I think the strategy is a little bit broken. That buy lots of little ones.
Tom Panos, who I chat to every now and then, he has a saying, and even you would do it yourself. I would imagine. I find myself sometimes doing it. You can't compare your chapter 1 with someone's chapter 9 or 10, right?
Yep.
And a lot of people look at your portfolio and go, well, I don't have a portfolio of that. I to earlier point around, I've got to do more this year in commercial buying. I go, I should have a much larger portfolio than I do, but there's reasons why I don't. And the reasons probably isn't limited because of access to capital or knowledge, right? I've got it in droves. It's around executing it, right? Yeah. So, I sit there and go, well, how come I don't have a portfolio as big as yours? I could do and I should do, but I don't do. And you've got to look at the individualized character of every single investor. Yeah. So you can't compare yourself with other people, particularly if you're, this sort of egotistical idea of it's important how many properties I've got so I can tell people like that. That's this is not what this is about.
So my strategy, I'm probably going to be consolidating, probably sell off a few smaller ones. What are you thinking of doing? Because you're in not a typical position. You're definitely an advanced investor with a lot of properties, commercial and resi. But what do you think your moves are for 2025?
Well, I don't want to refinance too much in the resi space, but back to the point, if I can extract equity to buy really good cash flowing commercial properties, which will contribute to the increased debt. So I still end in a
So like
neutral position.
100% finance to commercial.
But potentially,
Yeah.
yeah,
And I think that's going to be a very common strategy,
Yeah.
especially once rates drop, because
Yeah.
obviously you're going to have more fat in the serviceability calculations. You wouldn't really want to be 100% debt financing resi at the moment. Even if you could, it's just going to create a bigger problem if rates sit a little bit higher than what we thought. Plus the 2-3% net yields in resi, if you're lucky, it's still always going to cause a problem if you have too much debt versus that asset base. But what you said, I think you're going to be in a crowded space, and it's all about just getting to the right price point.
Yeah,
where
so
you can be above the clouds.
You've got to be above the clouds and aiming at that middle market stuff, right? Which we
Correct.
spoke about with Steve McKnight. So it's just really, and a lot of people would probably see it this way, and whether or not you do it, you can't look at your investments in isolation. You've got to look at them sort of holistically. So if you look at something and go, well, if I refinance a resi property, make it hugely negatively geared, in isolation in the bubble doesn't sound right. But if you're actually deploying that capital to actually get positive cash flow in another asset, which compensates for that, and you can view them as a pigeon pair. That's how I sort of view things, and that will be pretty much the building blocks for growing out.
But like, I feel really comfortable with the market. Like, it's not to sound cocky, but like you feel it on the ground. You see it. You see where rents are growing. You can see where supply is coming up. You can see which asset classes are moving the wrong directions. And I've got to be a bit careful, probably what I say, because every personal investor and resi agent will probably follow this advice. But we'll put it on the line. Like, I think retail is going to have the best year next year in terms of overall growth.
What sort of retail? Like, we're recording this in Sydney above the where you probably go shopping at Prada.
Definitely
fancy
not.
shirt you got on. That sort of stuff, or you think
probably not that? No. So I'm thinking like
street suburban,
big box retail, supermarkets. Like, even you can chuck medical into that, neighborhood shopping centers. Freehold stuff, anything with a decent yield in a good area that's kind of mispriced, you're going to see that have a good year. Remember, there's going to be more volume of people, non-commercial investors go into commercial. And one thing I've noticed over the last decade investing in this is most new investors look at retail first. And the reason is they're comfortable with the brands. They're comfortable because they've been in a shop. Do you think they understand the manufactured process of polymers? Probably not. In a warehouse, like, they don't know the fit outs of that. Like, it's sometimes these things are much larger, much dirtier. So industrial, although it is the flavor of the decade, it's still a little bit too far for someone who's never looked at this asset class. The more you learn about commercial, the more you'll kind of tilt towards industrial. Office, I think, is going to be left alone. A lot of the good office is institution stuff anyway. So, if you can, lucky enough to buy a great little legal business with an accountant there and a doctor, office can be great. I think office is a good investment if it's in the right area. But retail is going to have a good year. I'd be predicting anywhere from 5 to 10% growth for that asset class.
Okay.
Now, the one caveat to this prediction is when interest rates drop. If they drop in February or April or whatever, or May, whatever it is, it's going to really change these figures. If it doesn't happen, we're going to see the growth rate really slow. But high level, I think that's sort of, I'm seeing growth, and it'll probably could be a lot more in certain areas depending on what vendors are doing, and I guess more people flowing into it, but competing over low amounts of stock are always going to push prices up. Supply demand, classic. So industrial, I'd probably say a bit less, 3 to 8%. The reason, again, it's a pretty wide range I'm giving because, like, obviously we're chucking every capital city into this high level conversation, but the yields are a little bit tighter. There is more supply coming through, and I just think there's more upside in retail because of those two things. So, but it's still going to have a very good year. And if you pick up the right secondary industrial, you'll hit a home run as well, especially if it's got land. You heard from our last podcast, like land banking, positively geared land banking is always a good strategy. I personally wouldn't be going to things like service stations just because I think the long-term trend is not going the right way. Plus, I see hundreds of these off market for sale, and they're all trying to get us to buy them, and we're not. So there's a bit of supply in the background. Big companies are trying to sell out of those too. So I don't know, read between the lines there. Residential should have a good year, especially if interest rates drop. Some of that hurt you mentioned prior, it's probably going to dissolve a bit. People are going to refinance, and a lot of them are just going to go buy another house, But there's going to be more liquidity in the market. That's the big theme.
Do you reckon you got 2024 right?
I think overall, yeah. We're 4.5% off with the resi predictions. I think we predicted tight stock market, industrial was going to go well. I always think there's a flight to yield. Maybe that's my personal bias because I just know that's the strategy to follow long term, because there's an argument, well, there's an incorrect statement that people think if you get better yield, you're going to get lower capital growth. It's not the case. Like, if anything, the growth could be better, especially in these interest rate environments. And the proof is, how did prime industrial go versus high yielding retail? Chalk and cheese. They grew at different rates. So it depends on the strategies. There might be a strategy in 20 years where everyone wants lower yielding stuff because, I don't know, interest rates go to nearly 0%. Who knows? Then that prime stuff will go off its head. It's just not now.
Yeah. Okay. So to pin you down for 2025 predictions.
Yeah.
You sort of mentioned briefly, but order me the best asset classes from 1 to... So let's
set up guaranteed failure.
Yeah, absolutely. So office, retail, industrial, and specialty. So put them in order.
So I'll go a little bit more specific. So I think big box retail will be up there almost number one. Reason, again, slightly higher yielding than neighborhood shopping centers. So again, you're going to be in a much higher price point. Like, if you're buying a Harvey Norman, a Beacon Lighting, and a Pet Barn all in one, you're probably talking 15 mil plus.
Yeah.
Probably more like 25, 30. So that should be a very good asset class because yields are quite high. You can get 8% in those in this day and age. So it's pretty good versus the current interest rates, especially when you got 5-year plus whales on them. So neighborhood shopping centers will be up there as well. You could chuck secondary industrial right up there. Like, they're almost going to be equal tops. Secondary industrials, older sheds with better yields in good areas. And that good area could be regional, could be metro. As long as that kind of, I guess, areas around it's pretty stable in terms of population, business activity.
So you need good, local, vibrant regional economy.
So maybe for industrial, a 10K radius around it needs to be solid as a rock.
Yeah.
You don't need a 100K radius around it.
Yeah.
So that's why, like, people go, I want to buy in Sydney. Sydney's only influence, like, if you're on like a busy road, that connection route is going to be your main influencing factor, not the shopping center 2Ks down the road. So they're all got different metrics. Shopping centers are very 5-kilometer radius section. So if you're looking at a neighborhood shopping center, look at the 5K radius around you. How many other supermarkets are there? Are there more DAs for Coles and Woolies to come in? Are there, if you're buying a childcare, same deal. And then you can check what that area can cope with. And if it's undersupplied, you're going to do well. Simple. Especially if you can get that day one yield. Even freehold, fringe office should have a good year, because we're seeing investors re-enter that space because the yields are abnormally high on that. So you're going to get a much better yield than you would in those other types of asset classes. So yield seekers will target those types. Like, for example, we bought a few doctor studio type medical facilities with purpose-built fit outs, and they're just pure office with a good fit out. Government tenants, legal, accounting, recession-proof businesses like that. There's nothing wrong with them. They're professional tenants, but they've been overlooked because of the shade the CBD office market has cast over that whole asset class. Ones that won't do well, I think long-term service stations are just on a slow decline. They might be in good areas and that, but we all know the environmental, rehab you need to do to the sites. Just the funding is a bit difficult. Like, I like the cheaper ones. If you were going into that asset class, like, just don't buy a $6, $7, $8 million one, because you may as well put your money somewhere else. But cheaper ones can be good deals because they could have 15-year leases to Mobile or something, or BP. Nothing wrong with that. So yeah, and I think certain types of, like, the lower yielding resi market will struggle. We've seen it at the end of 24, but eventually they'll bottom out and turn around when the interest rates do. So really mixed bag. So I guess
a lot of what ifs there. So give me a prediction on interest rates then.
Oh, look, I'll just go what the money markets are saying, because I'm a big believer the markets just sum up everyone's opinion as quick as possible. 2 rate cuts.
When?
First and third quarter, It's total guess, but I don't think they'd do 2 at once. But then again, that's what they did in other places. Like, they did that in New Zealand. They've done it in the US. Many of the other European countries are doing that as well. So, this could be completely wrong. I personally hope they don't rate cut in the first half.
Yeah.
Just
I was going to say the same. Yeah.
I just think it's just going to get a bit silly after that. Like, the dumb money will enter the market like it always has. Like, the last time the dumb money was in the market, when I say dumb money, aggressive. I've got to buy now, just buy something.
Just FOMO stuff.
Yeah, FOMO is probably the better word, but that was back in early 2022. It was off the chain. And I don't want to be purchasing for clients in that market. It's going to happen, no doubt, but hopefully there'll be more supply to counteract that. And maybe there is a bad economic story for the reason of the rate cuts, which will scare off some people anyway. It's never going to be perfect.
Good luck seeing those interest rate cuts handed down to you without you kicking and screaming to get them.
Yeah.
There's a hot tip for everyone, right? Like, just don't think, 25 basis point reduction, they're instantly going to pass on 25 basis point. You're going to have to kick and scream and fight hard to get any sort of savings passed on to you, which may mean that you may need to shift lenders.
Yeah. And even if it do 0.5%, would that change the fundamental issues of the portfolio?
It's not going to change a lot.
It's more important just to get the right assets when you can afford it and plan to hold for 20 years. Your interest rate's going to do all sorts of things in 20 years. So who cares what it is next year?
Don't make your buying decisions or investment decisions on whether or not interest rates may be cut a couple of times, 50 basis points over the year. Because if that's the case, and that's going to shape and determine where you buy and what you buy and when you buy, you probably shouldn't be buying.
Yeah. I plan rates to be where they are long term. You know, if they come down, that's a bonus.
Long term averages. So give me some prediction around the election. Will it change anything?
Oh, look, history tells you no matter what the result, it creates stability because elections kind of put everything on pause. You and I have been through a number of these in our investing career, and everything kind of just goes on hold for a few months prior. It's like this silly season of not much happening.
Yeah.
Not bad things don't really happen before or after, it just goes on pause, and activity then picks up after. People choose to sell a house after an election. If you look at what happened in the US, I think 1.6 trillion of stock market value was created in 24 hours, and then more after it, then some lost. So basically activity happens, financial activity. So, good time to invest prior. But yeah, again, lower stock. So you're choosing against less options.
How well you do as an investor, commercial, resi, combined portfolio, whatever you got, it all comes down to your ability to obtain finance. Now, commercial finance, if you go down like lease stocks and stuff, you've got a more vibrant business community. There's going to be greater confidence around ability for them to pay rents. Leases are probably going to stack up and have greater integrity. Therefore, funding may be easier in that regards. In the resi space, serviceability is still tough. We see APRA come out last year pretty much saying, no, we're not shifting on serviceability buffers.
Well, I think one prediction based on what we know right now that should be fairly predictable is finance should get a little bit easier overall, because one thing I've seen over the years is when there's the threat or opportunity of a rate drop, the banks actually move first to sometimes offer like fixed rates at lower amounts, or their serviceability kind of relaxes. Definitely in finance. So we saw it actually, towards this third quarter of 2024. There was actually a lot more policy change, which was helping because they were predicting a rate cut a little bit more at that time. Then when that went away, they pulled out those policies. So like every month it was changing. It's going to change a lot this year. So I think it'll be overall better for investing. They're going to create liquidity, more banking competition.
Well, banks want to lend money, and we saw it towards the back end of 2024, and we've spoken about in this podcast, when you think about, the certainty of commerce of investing in real estate in Australia, you've got a lot of big friends who are backing you, right?
Yep.
Like resi and commercial, yes, resi's a much bigger market segment. It's probably less risk. I'm generalizing there, but banks are in the business of lending money because that's how they create shareholder value. They want to lend money, right? The government has orientated Australia's rental markets towards the investor, right? So there's incentivization around it. The government now is putting equity into property ownership through shared equity schemes, right? So like you got a lot of people there who want to ensure that the property market is good moving forward. One thing that I saw, which I really caught my attention latter part of 2024, was broker market share has just, if you round it up, it's 75%, right? And you've got a very good broking arm as part of the Rethink group. We've got a mortgage broking company, and I think you're mad to not use a mortgage broker. So back to finance predictions, there's going to be innovation in finance, resi, and it's going to be subtle innovations. Yep. But if you're not using a broker like Som and your team, like you're absolute bonkers. Like, why aren't people doing that? I don't understand.
And the points you raise, like, it's funny, you were mentioning like Australia backs property, whether it's the government, the banks. Like our banks are, they're Goliaths. And, all these people are backing it. Then you've got the immigration. They were the exact reasons back in the day when I first started investing. I was like, well, because I was scared of losing it all, and this was back in 2010 when the US was going the other way, massive percentages. But Australia was different, and we proved it. Like the market never really dropped because it's just all these levers we just keep pummeling into the property market. And the good thing is the banking sector is better than ever.
Yeah.
There's more competition. They're pretty strict. APRA's like, I heard people crying that they've held first homeowners out of the market because they're so strict. I hear that as, yes, it's bad. We want them to buy. We want first home buyers, but it just means the market's very stable. Like, because you wouldn't want them buying and then the market drops and then they're in negative equity and then their life's ruined.
Last thing, that's when, and you saw sort of that Harry Dent guy out of the US was
and that's why he's wrong forever because of that.
Look, it's probably a prediction. Mindset shifts and changes. I think Australians, there's the mechanism for education for around property. It's more today than what it ever has been. But I think a lot of people's views are still misaligned. Expectations around property is misaligned. Again, you can't compare what you're doing to other people. It's impossible. For first home buyers, getting into the market where you get into the market, it's a very tough situation. But, talking about immigration and changes in government, what that will do, it's still bloody hard to make a development stack up, resi development stack up in Australia under the current economics of it all. And, labor's expensive. The construction sector is heavily controlled and orientated towards a lack of productivity. There's a lot of issues that need to be dealt with, right? The construction industry is critical to Australia. So many jobs orientate directly within it or from it. And there's a lot of work to do there, right?
And one of the, I guess, long-term things is like the only way to fix the housing crisis is building up, probably, unless you start.
It's a mindset shift as well. Australia's got to grow up and know that the way we used to live isn't the way that's going to be moving forward.
So as an investor, like the main message there is like, all right, well, I'd want to pick properties with land because if let's say one day they really release the councils and start going nuts building high-rise, like I think there'll be short-term really big gains in high-rise because they're priced pretty well at the moment. But long-term, if you own the land, it's a scarcer product. It's a kind of an end game property too. So land should appreciate a lot more than units because of the supply and the long-term fact that people want backyards. So if you can get into a house, you're probably not going to go too wrong.
Not going to go too wrong. And that also, extrapolate that out back to finance. There's a lot of postcode restrictions coming in place right now. With high-rise stuff. So be
like
careful.
The Gold Coast.
It's getting. But back to how do you extrapolate equity out of your portfolio, or how do you actually get started? You need a confidence around debt. But if you want to accelerate buying this year in 2025, you need dough to start with, right? And back to speak to your mortgage broker. Give your team a call for sure. That they can go through all this sort of stuff, but there's some lenders now, you've got to really scratch the surface and then dig down and you'll find some really good stuff. I know some lenders are now doing 95 or 97% finance, no LMI, in certain postcodes. You can, you've got multiple $1 million houses. You can pull $1 million out of that, without LMI. And that's cash you can deploy.
Exactly.
You can really deploy that quickly and start playing in a certain sphere of commercial property. $1 million in cash will get you a pretty reasonable asset, I would imagine.
100%.
Commercial.
And I regret not using a specialist mortgage broker a lot sooner. I started with the banks and then years later I went to an Aussie home loans broker and that changed my life with the resi side. But then I stuck with that too long before going the commercial specialist. As soon as you talk to them, there's just so many more options. So, if you're thinking about commercial, talk to a specialist commercial broker because that was my biggest regret. I probably lost 3 or 4 years and went the wrong path too long because of it. So they will change your investing game if you engage them as sooner.
So lots for us to talk about this year, mate.
Plenty.
There's no shortage. And for you, what's going to be how you measure success for Rethink in 2025?
Doing well for as many clients as possible. I think it'll be a very good year in terms of volume, in terms of yields, in terms of capital growth. Like it's all pointing in the right direction. So it's definitely a good market to play in. It's just getting access to enough stock. We've got people in every corner of the country. So we've got the market covered. So success for us is to maintain that coverage to deliver enough properties for our clients. And we're going to warn people not to buy as much as possible if it's not suitable. So we've got the clients. We don't necessarily need to talk up business. And so success for us is to making sure the right investors invest in the right asset class at the right time. And, if you are going resi, there's some great opportunities. And if you pick the right market, you might get a Perth-like result. So, I'm excited for the year. And it's all about building equity and cash flow for as many clients as possible. And that's the exciting part for us.
A couple of burning questions, which is how we like to finish up. There's a question here around supply coming to market in states and certain asset classes. Where do you think supply is probably not a bad thing for good supply is probably not a bad thing for competitive tension on, negotiating better outcomes for clients. Where do you see the supply sort of being the most vibrant?
So the supply is going to come in the small industrial space. So you've got to be a little bit careful there. Good quality industrial space at the right square meter rate. So, if you're buying below what others are selling for, great. You need a rental guarantee because what will be unpredictable will be how many tenants need these new spaces. Mm-hmm. So whether it's Melbourne, Brisbane, Perth, because the price growth has been pretty solid in that price point, you just got to be a little bit wary that developers now can make margins. They won't make margins doing big sheds because they might sell them at, hypothetically speaking, at 3,000 a square meter. But if they can sell it at 6,000 a square meter just by putting a few extra walls in it, you're prone for extra supply. So just be careful in that space. We buy new stuff, but it's generally got a pretty long rental guarantee and it's at the right square meter rate. I bought one of those in my Supra, gone great. But that's a warning. Be careful in that space. Supply will continue in the CBD office markets, but what will halt supply is most people that own that are very rich or institutions. So if they're not getting their right price, they just go, stuff it, I'm not selling.
Yeah.
That's why stock has kind of dropped over the last few years, and that trend will no doubt continue until prices are there. And unit suppliers, they're gonna build more. You just got to be. It's all about understanding what the council's doing and be wary that what the current supply is not equal to the future supply. There's probably going to be more coming, so just don't get caught out in that situation.
Okay, some other really good questions here, but I think we should do a whole podcast on them. So I'm going to ask one more, Scott, and it's quite a tactical thing. Should you pay off your commercial loan, look to sit in the offset account and use it as a deposit for other properties once you have enough?
Yeah, look, good question. If definitely use an offset account, you're mad not to. It's better to offset your non-tax deductible debt. If you're lucky enough to have a home, stick it in that because, you want to maximize your investment debt from a saving a tax point of view, and then plonk it against the house, which is, not working debt. It's not going to give you the same outcome from a tax point of view. But look, it's a good strategy to expose yourself to as much of the market safely as possible. So if you can, if you've already got an industrial, maybe go retail this year. They're all going to perform differently. And this is why I've spread my portfolio over different states, different asset classes. I know a lot of people only wanted industrial the last 3 years and they've got big industrial portfolios. But what if in 20 years' time, for some reason, they start building multi-story industrial in the CBDs and now no one wants to be out there? I don't know what's going to happen. It's a prediction that no one can really know. So you've got to diversify for the long term because no one has a crystal ball.
Well, good way to kick off 2025, mate. I think we did pretty well.
Yeah.
Did okay in 2024. We got most things right. A lot of things you just can't call. In 2025, I think your sentiments around which assets are going to perform the best. But, I think if I was going to summarize what 2025 is going to be, it's going to be a tale of two halves. You're going to have pre-election and post-election. And pre-election, a lot of that's going to be connected in with what happens with interest rates. It's all going to be bundled up together and get used to hearing of a lot of arguments and policy announcements sort of coming down the line. A lot of stuff you're going to be scratching your head going, I don't really understand any of this. But that'll be the first half, and the second half will be let's get down to business, whatever that looks like.
Yeah. No, I totally agree. The US, it's happened. There was nearly a civil war there at some point, and then that obviously will tame the markets. And once, whatever happens, then as you said, people get back to business. You still got to live your life, set your life up. Who cares about the election? Just move on. Whatever decisions are made, there's always a way around things legally to benefit you. And that's how investors should think.
Well, I hope everyone's tuning into this, drinking a pina colada or somewhere or other, or a beer or taking it easy over the summer break. So use this time to continually shape your attitudes towards investing in property. This is 50 plus episodes in, so pretty much everything we've recorded over the last few years is probably still as relevant as what it was back then. Slightly different, maybe nuances to keep in connected with the current state of the economy and the direction of it all, but the basics are still there, and there's a lot of clues in all these podcasts of how you should be shaping and directing your commercial property investing. So look forward to 2025 with you, mate.
Yeah, you too. Thanks again for another great year, and look forward to seeing how this year plays out. I think it'll be the best year, almost the best year. It'll rival the 2021 era, I think.
Okay, so there we go. Happy days.
That's if that happens, or even half that happens, it's going to be a good time. And interest rates are the big change here. So that's kind of the elephant in the room. Whatever happens with interest rates will dictate how much things happen and how fast.
Yeah, and to the point, it'll set us up for knowing what the next period is going to look like, at least the next sort of 3 or 4 years. I know your team are all on leave, but people can probably email them still if they want.
Just info at rethinkinvesting.com.au. We've got skeleton staff during the holiday, but just have a chat. We'll be back on the 13th of January, and the market's pretty quiet all January, so don't expect to be flooded with properties. And February is kind of when it starts, but then you get a really good period after that where everyone's listing, and that pretty much continues on throughout the year.
So this is Inside Commercial Property with the Rethink Group. Thanks for tuning in, everyone, or watching us wherever you're seeing this. We'll see you next time. Until then, bye-bye.